The financial landscape is constantly evolving, and one of the most significant shifts in recent years is the so-called Great Rotation, the movement of capital from bonds to stocks. This phenomenon reflects changing investor sentiment and strategic asset allocation in response to various economic and market conditions. Understanding the drivers behind this rotation and its implications is crucial for investors looking to optimize their portfolios in a transformed investment environment. The driving forces behind the Great Rotation. Several key factors have contributed to the shift from bonds to stocks. 1. Interest rate environment. Historically low interest rates have significantly reduced the appeal of bonds. Central banks around the world, particularly in developed markets, have maintained low or even negative interest rates to stimulate economic growth. As a result, bond yields have been compressed, diminishing their attractiveness as income-generating assets. 2. Inflation concerns. Rising inflation expectations have further eroded the real returns on fixed income securities. Inflation diminishes the purchasing power of bond interest payments, making them less appealing compared to equities, which have the potential for higher returns that can outpace inflation. Economic recovery and growth. The global economy's recovery from the COVID-19 pandemic has bolstered corporate earnings and increased investor confidence in equities. With economic growth picking up, companies are reporting stronger profits, which drives stock prices higher and enhances the attractiveness of equity investments. Risk, appetite, and sentiment. Investor sentiment has shifted towards a higher risk tolerance, driven by optimism about economic recovery and growth prospects. Equities, being riskier assets compared to bonds, offer higher potential returns, appealing to investors willing to take on more risk for the chance of greater rewards. Implications for asset allocation. The rotation from bonds to stocks has several implications for asset allocation strategies. Diversification reconsidered. Traditional diversification strategies often emphasize a balanced mix of stocks and bonds to manage risk. However, in the current environment, investors may need to reconsider their approach, with bonds offering lower returns. Alternative assets such as real estate, commodities, and private equity can provide additional diversification and potential returns. Equity emphasis. Increasing the allocation to equities can enhance portfolio growth potential. Within equities, diversification across sectors and regions is essential. Growth sectors like technology, healthcare, and renewable energy offer compelling opportunities, while emerging markets can provide higher growth potential compared to developed markets. Fixed income alternatives. For investors seeking income but wary of traditional bonds, alternative fixed income investments such as high-yield bonds, dividend-paying stocks, and real estate investment trusts, or REITs, can offer attractive yields. These alternatives come with higher risk but can provide better returns in a low interest rate environment. Active management. The changing landscape underscores the importance of active management. Passive strategies that track broad market indices may not fully capture opportunities arising from the rotation. Active managers can identify undervalued stocks, navigate sector rotations, and adjust allocations based on evolving market conditions. Risks and considerations. While the shift from bonds to stocks presents opportunities, it also comes with risks that investors must consider. Market volatility. Equities are inherently more volatile than bonds. The potential for higher returns comes with increased market fluctuations, which can be unsettling for risk-averse investors. Managing exposure to volatile assets through careful asset allocation and risk management strategies is crucial. Valuation concerns. The strong performance of equities has led to higher valuations in many markets. Elevated price-to-earnings ratios can indicate that stocks are expensive, which may limit future returns. Investors should be cautious of overpaying for growth and consider valuation metrics when selecting investments. Interest rate changes. While low interest rates have driven the shift away from bonds, any sudden increase in rates could impact both bonds and stocks. Rising rates can lead to bond price declines and increased borrowing costs for companies, potentially affecting corporate earnings and equity valuations. Strategic considerations for investors. Long-term perspective. Investors should maintain a long-term perspective and avoid making impulsive changes based on short-term market movements. A well-thought-out investment strategy aligned with individual financial goals and risk tolerance is essential for navigating the Great Rotation. Long-term perspective. Investors should maintain a long-term perspective and, avoid making impulsive changes based on short-term market movements. Regular rebalancing. Periodic portfolio rebalancing ensures that asset allocations remain in line with investment objectives. As markets fluctuate, rebalancing can help manage risk and capture opportunities by adjusting exposure to different asset classes. Professional guidance. Seeking advice from financial professionals can provide valuable insights and tailored strategies. Financial advisors can help investors navigate complex market dynamics, assess risk, and make informed decisions that align with their goals. Conclusion. The Great Rotation from bonds to stocks reflects a significant shift in the investment landscape driven by low interest rates, inflation concerns, economic recovery, and changing investor sentiment. While this shift offers potential for higher returns, it also entails increased risks and challenges. By understanding the drivers behind this rotation and adopting strategic asset allocation approaches, investors can reposition their portfolios to capitalize on opportunities while managing risk in a changed landscape.